All right, so let me go ahead and get started. Obviously I'm Larry, the host of Tech Talks. This is SRM Tech Talks. We've been doing this now for about 2 years. Prior to that, we had Crypto University, which we did for about 2 years. And I truly appreciate everyone that joins in on these live events. A number of you have made almost all of those calls. We do this every 2 weeks, and it's a ton of time commitment, right? Because it's long form. I'm really excited to announce that, it seems like a 2 year series, but next year we're going to be rebranching and relaunching Tech Talks as Perspectives Live. So we've got a lot of things at SRM around Perspectives, kind of as a sub brand, if that's the right word. And Perspectives Lives is going to be kind of our tech talk, but on steroids. So we're going to be doing a new platform. We are requesting people opt in so that we can email you notices of these Perspective Live events, and really excited about this upcoming year. I think we've got a lot of great hosts, and I'm super excited that Barbara is here. So Barbara, you get to wrap up the end of an era and a start of a new one with Tech Talks. And as everyone knows, we've been focused now for, again, last about 2 years on the intersection between technology, emerging technology, particularly fintech, and traditional financial institutions, right? So TradFi and then kind of emerging fintech technology. And, looking at that stuff, regardless if it's a threat or an opportunity for these institutions, but trying to understand what it is and where it has its place in kind of traditional banking. The people who tend to attend these calls are financial service executives, a lot of credit union leaders, a lot of community bank leaders, some fintech folks as well. Catalina obviously introduced the two of us, so we've had a conversation once before. You've got a really unique background and super excited, and particularly to see, and we'll talk about this today, but another woman in the crypto digital asset blockchain space. And it seems like there's too few of those. I know Patty's on this call and she's very much supportive of that as well. But, I think we need more women, more diversity in this growing space. So I'll be excited to talk to you about that as well. Catalina, did you want to give any background before we let Barbara talk a little bit about her CV and what she's done, and she's an investor and she's got a startup and has worked with a lot of startups in the past, very 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 successful. Do you want to give any background on Barbara before we turn it over to Barbara?
Oh, absolutely. Thank you, Larry, and thank you for giving us the opportunity to present. In fact, it's definitely Barbara, the one presenting today, but I actually came across Barbara as part of the work I do with How Women Invest, and she was presenting, and very few companies in the Web3 space, like you mentioned, are women-led, right? So, How Women Invest specializes in how women women funded and run companies. And then, of course, I'm very passionate around the space between traditional finance, Web3, and now, overlap AI and all that stuff. So when I started talking to Barbara, I said, wow, you really are up to something here. Plus, the other thing that's interesting about Barbara, she also comes from the traditional finance space, like earlier in her career. So she's able to navigate both worlds and understand them very well. So that to me was very attractive because, we all come from the traditional finance, many of us, and it's nice to have that background in order to connect the dots, right? And see the use cases and value added of everything that the Web3 space and digital assets are going to bring to the infrastructure, not the financial system. So that's what I'm going to say, because Barbara has a lot more to say. You can also see her LinkedIn. And she's just an amazing entrepreneur, professional, very smart. And what she's after here is very powerful. So, Barbara, with that, I'll leave it in your hands. Thank you.
Well, thank you very much. I know, Larry, you're sort of running the questions for this. So please start off with any questions. But I just want to say thank you for having me. Catalina, thank you for inviting me. And to everyone on the team, please, on this call, please chime in with any comments or questions. I'm not the be all end all here. I'm just starting a conversation and trying to get everyone involved in the space. It's really exciting.
Well, with that, Barbara, if you can start with a little bit about your background, what got you interested in this space? I know you come from a banking background, so you're approaching this much the way that a number of us are from traditional finance. And then what got you interested in kind of digital assets and blockchain? So maybe give us a little history of yourself.
Yeah, sure. So I went to college to study electrical engineering and computer science. I've always been focused on technology. But my father was a banker, worked at First Chicago Bank when he lived in the US, and then also built a bank in Nigeria. So I always knew I wanted to get into finance and the impact of financial services. So when I graduated from business school, I did investment banking at JP Morgan. Through my experience at JP Morgan, obviously really got very close to understanding the financial services industry and all the key revenue drivers of JP Morgan and a lot of the blue chip banks. And then after that, what really got me into the fintech space was I was part of a private equity platform where was founded by Bob Diamond, who used to be the CEO of Barclays. And it was focused on investing in financial institutions. And I was part of building a digital bank. And that really got me excited about the financial technology opportunity. But my first investment after I left that platform was a blockchain payment company. And that's really what got me excited about the blockchain. Essentially, the blockchain for me was what fintech does not solve today, right? All the friction that we deal with from a fintech perspective as a fintech investor, I believe the blockchain can solve. And so that's really what got me excited about it and sort of leapfrogging into blockchain than hovering around the fintech opportunity that wasn't addressing the underlying issues. As a venture capitalist, I decided to set up one of the few blockchain focused funds that invest in, I would say, stablecoins, stablecoin payment companies, and embedded finance opportunities that can scale across emerging markets. From my experience, I saw that the markets that are going to eat up these technologies are going to be in emerging markets because they don't have the legacy infrastructure issues that developed markets like the US has. And they're just doing a lot more innovative things around identity, around fast payments, around this infrastructure. And so that's really what got me excited about creating a fund focused on that. Through that fund, I moved on to another thing as well, which is stablecoin payment liquidity. Because what I saw was in the last couple of years was while the blockchain is really effective and stablecoins have now become really effective, and I could talk about some of these things specifically, there's a need for stablecoin payment liquidity. Just like there's a need for fiat payment financing liquidity, there's a need for stablecoin payment liquidity. And so I set up a company called Liquid Credit to address that issue head on as well.
Wow, you covered a lot there. Just for people who are aware, I mean, your background too, you mentioned university. I think you're a Columbia grad and Harvard grad. So you're obviously a smart person. Did any of I'm curious when you were in school, was any of this stuff covered at all, or did that come later?
When I was in undergrad, I was really focused on infrastructure. So I've always been very cognizant of the need to have this foundational infrastructure that drives applications and software. That has always been an area of interest of mine, and because I was an engineer. But business school is where I really started thinking through the opportunity around technology and finance. And that's where I really learned more about entrepreneurship. And when I got an opportunity essentially to start building firms, a growth equity platform, a VC firm, and now a startup, I really focused on what I saw as the biggest problem within financial technology, which is this blockchain infrastructure layer. So yeah, it really came from my background across finance and engineering.
So your business hypothesis was certainly correct in looking at emerging markets and assuming that they would be the first ones to adopt that technology. I'm curious if you kind of look to, like, there's a number of continents where the telcos and the telephone companies weren't quite, they hadn't run copper lines everywhere, right? In the cell phone technology came in about the same time as those lines were going out to more kind of
right.
rural areas. And in fact, they just said they scrapped the lines and just leapfrogged and went to the cell phone technology. And interestingly enough, a lot of those became right into the digital asset space because they started using their phones for banking and in fact using the cell phone minutes as currency. So that, there's a lot of history in some of these emerging markets where they have adopted a lot of technology faster than in kind of this developed countries that we have. A lot of it's what we've got is, you've got incumbents and you've got technology that does a reasonably good job at working. I think the interesting thing when I think about it is these new technologies, they compete with the old, but they've got advantages, right? They've got advantages in that they're cheaper. They've got advantages that they're not as tied to these old legacy software platforms. They can adapt faster. It's all been made with newer technology. So with that, kind of talking a little bit about, before we talk about liquid credit and the company you started, it sounds like you might have started a few of them. As an investor, I don't know if you've always invested in blockchain or you said technology. How is investing in blockchain and digital assets different than maybe fintech or more traditional companies from a VC standpoint?
Yeah. So on the macro level, not necessarily my thesis, but on the macro level, there are clear differences, right? I think the blockchain fundamentally is an ecosystem that's decentralized, and it's about giving the ownership to individuals, to communities, versus centralizing that ownership. And so fundamentally, when you digitize that ownership, the value is gonna accrue in different ways. As a traditional investor, the value accrues to a few individuals on the cap table, which is in the equity. And as a blockchain investor, the value can accrue to communities that own your token, that have ownership of this digital representation of whatever value you're creating on top of your equity. So those are two different models on a macro level, and you can apply that. There are many different aspects of companies building on the blockchain technology, from gaming all the way to like traditional payments. I mean, there's a lot of things in between. But fundamentally, that model is about giving the ownership and power to communities versus equity, which is very limited and centralized. But on the micro level, which is my fund thesis, I was focused more on the intersection of traditional finance and blockchain. For me, I was trying to solve an underlying problem that traditional finance around financial infrastructure. And if I'm investing in a fintech company and it's still hard to move money, it still takes 5 days to move money from one country to another, we're not solving the problem. If I'm investing in a fintech company and the banks that are part of the network or the other fintechs that are part of the network are still dealing with reconciliation issues, and instead of solving that reconciliation issue, we're building software patches on top of each other. We're trying to connect APIs, and stitch APIs together, instead of just figuring out a way to eliminate this reconciliation issue in the first place. And so for me, these are the bottlenecks I was dealing with in fintech. If you're a lending company, you struggle with getting liquidity because you still have to, banks aren't lending to companies, lending to merchants, to small businesses. So how are we solving that problem? So for me, I believe the blockchain could solve some of these issues. Blockchain eliminates reconciliation issues. Blockchain makes instant transactions. Blockchain provides liquidity that could finance insurance, lending pools. Blockchain democratizes access to finance. So when you're building, in the wealth management space, it's not just to, accredited investors. Now you can fractionalize that to any investor that has $1, right? It just changes the dynamic. As a fintech investor, I go from here to here.
Now as a fintech investor, it sounds like some of the I think I might have talked over you. Are you there? Yeah, I
Let's see.
think she might have.
Oh, there she's back. Oh, there you are.
You're back.
Yeah.
So Barbara, as a fintech investor, it sounds like some of those investments were global, and I'm curious if they were global because that's where the opportunity was, and or because in the U.S. we'd had such a kind of a hard-handed regulatory approach around it that the opportunity was really elsewhere with the expectation that eventually the U.S. would catch up as it often does. Was that any of your decision process, or was it just that that's where the opportunities were internationally?
For my thesis, which was focused on blockchain-powered financial infrastructure, I believe the opportunities were in emerging markets. So when you think of stablecoins, which is the three aspects of my thesis around blockchain-powered financial infrastructure: stablecoin payments, real-world asset tokenization, and embedded finance. Stablecoins are the future of moving money. The moving money rails are going to be using stablecoins, and obviously, we've seen how stablecoins have grown from 5% of blockchain transactions in 2020 were using stablecoins. Now 50% of blockchain transactions in 2024 have been with stablecoins. So that thesis, when I started this conversation in 2020, has proven itself. Real world asset tokenization, we've seen how tokenized treasuries have gone from 0 in the last couple of years to 2 billion plus. And it's a $16 trillion industry. Embedded finance, we're seeing the intersection of fintech and AI and blockchain in financial applications, and that is multi-trillion-dollar industry. And so that was my thesis, but I believed that the markets that were going to eat this technology and the use cases for a lot of these technologies were really going to be around emerging markets. So if you think about stablecoins are mostly used in emerging markets for payments than it is in the US. And if you think about real world assets and tokenized treasuries, a lot of emerging markets that want access to dollar yield are using these assets because they are dollar denominated yield and they're on the blockchain, so they can be accessed anywhere in the world. So in areas where they're starving for that yield, there are huge communities accessing it. And then we have AI that obviously we know that's a whole conversation in itself that's just eating software as we speak. And so that's why.
For those that aren't aware, I mean, there's international money movement kind of at the corporate level. There's international money movement at the retail level. The retail level, that cost of money movement is something the World Bank and a number of other kind of international agencies are focused on. But that average cost to move money is about 6% of the value of whatever you're trying to move. That's come down considerably from, say, 10 years ago, where it was about twice that. But still, 6% is a huge amount of money. And in fact, Barbara, you mentioned that like stablecoins starting to be used. In fact, it is being used, right, to move money today. Stablecoins move something like $15 trillion of asset movement. Now, some of that has to do with crypto. Some of that has to do with true movement cross border. But like that's a significant amount. And the other thing that's going on is correspondent banking in a lot of places in the world because of the regulatory headaches and just the cost of doing it have pulled away in some markets where all of a sudden that's not an option anymore. So stablecoins are starting to fill that vacuum. And it's really important for people to understand, like, this is a technology. You think about what the U.S. developed with FedNow. And I always laugh when I'm talking about my fellow U.S. Faster Payments Council folks like Lou, is whenever they're talking about, okay, here's this faster payment and it's going to get there immediately and it's immutable and we can trace it and it's real money. I'm like, yeah, Bitcoin's been doing that for 15 years, and like stablecoins are already doing that and serving that purpose. Now, of course, there's certain reasons why governments would want that, and some of that's done at the corporate level, but you're right. It's huge. And then digitization of real world assets. I mean, that's something like a $20 trillion opportunity. I mean, it's absolutely massive how many real world assets are starting to be and can be tokenized, to your point, bonds and things like that. So I think we all agree there's a huge opportunity here. So talk a little bit more about what Liquid Credit is doing. What are you solving for? You talked a little bit about, these stable coins and how that money moves and getting liquidity to kind of back that. Maybe you can talk a little bit for folks, describe kind of what a stable coin does, how people use it, right? There's people who use it for payment. There's people who use it for settlement. There's people who use it as a store of value for U.S. dollar, right? To hold kind of U.S. dollars in monetary regimes that don't normally allow them access, or that, a local currency fluctuates so much or is deflating or inflating away so much that, they'd much rather hold U.S. dollars, and it's a vehicle for that. So talk a little bit about what stable coins are, kind of uses of those. You touched on some of those, and then, when that money moves, how a stable coin works, right? Because it's backed by U.S. dollars or some sort. It can be backed by anything, but it requires a certain amount of liquidity, and why that liquidity is needed, and who typically provides that as a solution.
Yeah, no, that's great. I think the first thing to understand is stable coins come in different shapes and forms. And I think the market has seen different types of stable coins and how some of them have worked and some of them haven't. I think where the market what the market is accepting now is stable coins backed by fiat dollars, right? Fiat dollars or fiat currency, because it could be non-dollars, but fundamentally backed by fiat. I think we've seen examples in the past where stable coins were backed by other cryptocurrencies and a lot of things became a mess. I think people are realizing that we should be doing software engineering, not financial engineering. And so fundamentally, that is what a stablecoin is. It's just a digital representation of a fiat currency. Why it's powerful is that it can be essentially used to move money on a computer, right? On computer networks, right? And because of that, it's more efficient. It's transparent. It's cheaper, and that becomes a key foundation for a lot of the use cases that are coming out of stablecoins. And one of them, like you said, is instant settlements, right? If you want to move money and it's instantly there, it's done. Settlement is one of the biggest challenges across this multi-trillion-dollar money-moving world that we live in. Another use case is that because it can be accessed anywhere, it can be a store of value, right? Anyone can access that digital currency, that digital dollar, anywhere in the world. So places where they need access to dollars and their capital controls in their different countries, they see a lot of devaluation. Argentina, Nigeria, all these countries have seen a ton of devaluation. Getting access to dollars in these countries is really hard because these countries are dollar scarce, have literally need dollars every day, and the banks refuse to put out more dollars. So you go to a bank and you have to do all sorts of things just to get dollars out of your account, right? Getting access to a stable coin it's a much frictionless opportunity and is much more available.
Barbara, can I ask a question? Because I think this is true, even with SWIFT and all of that, there isn't really a solution for worldwide commerce where settlement is instant outside of blockchain and stable coins. And if you think about things like trade finance, where it's important to get those funds moved as quickly as possible, else things in the supply chain can't move. The ability to have an instant payment in something that is traceable and verifiable by multiple parties is really, really important, right? And
yeah,
I think we've seen some countries actually start to use it in standard business transactions. So I think Saudi Arabia recently used a stable coin to settle an oil transaction. You mentioned stable coins are often backed by fiat. There's U.S. stable coins. I think there's Euro stable coins, but there also
non-US,
are. Yep. And then there are stable coins that can be backed by hard assets like oil or gold,
yes,
or a bucket of currency like Libra tried to do back in the day. And there's all sorts of various reasons why that failed.
Yeah.
But you're right. It's a really powerful way to move value across international borders instantly and quickly. And as we move to an economy that's connected 24/7, 365, like to rely on the banking system to do that, where different countries have different bank holidays. Banks aren't always open 24/7. Right now, the only way to move that money is through a correspondent system. So, requires passing money to a correspondent bank and then them dealing with local currencies and passing it to a local bank. It's a very complex money movement process that takes days to accomplish.
Yeah, absolutely. And your question around liquidity and why it's important for stablecoin liquidity. So we understand the importance of stablecoins. Why we need stablecoin liquidity is really around the same issue in a slightly different way. So we need stablecoins because we need to reduce the delay in moving money around. We need stablecoin liquidity because there's a lot of conversions between fiat and stablecoin that's still necessary, right? If you're trying to move money, that money still has to, you're still getting fiat, you convert it to stablecoin, and then you convert that stablecoin to fiat. These steps create delays. And the reason why there are delays is because moving that fiat, even to convert to stablecoin, still takes time. In America, if we want to move money from, if a consumer puts their debit card and we're trying to get that money out of that debit card into our bank account, it can take a day or two to do that, right? And so these delays between fiat and stablecoins require a lot of transactions to be pre-funded in stablecoin. So if you want an instant transaction when someone decides to put their debit card and put fiat and say, I want that fiat sent to Mexico right now, practically that takes days to happen, right? But if you pre-fund that transaction with stablecoins, you send a stablecoin to Mexico, and someone in Mexico converts that stablecoins instantly to fiat, that transaction is done instantly. And so a lot of fintech.
Let me ask you a question about that. Is because I can see certainly a lot of stable coins would need that liquidity solution. A Coinbase or a Tether that has a treasury of X number of U.S. treasury bills or bonds and maybe corporate debt, who knows, but like they've got a bunch of assets sitting in an account somewhere. That in essence is already pre-funded, right? So if you're using if you're going to turn if I want to send stable coins, I've got to convert that to US dollars. But the stable coin that's printed or minted already has US dollars backing it, right? So is it my money when I'm trying to, let's say I'm trying to buy something big overseas, it's a $20 million, I don't know, inventory of something, I need to be able to come up with that $20 million to fund that and to pre-fund that stable coin. Is that how that works? Or because like some of those stable coins are already pre-funded.
You said two different things. Two different things. Yeah. Stablecoin payment liquidity is different from what backs a stablecoin, right?
Okay.
So Tether, which is USDT, which is one of the largest stablecoin issuers, their market cap is like 170 billion or something. Circle, which is the second largest stablecoin issuer, which is about 20 something billion, their USDC. Both of these stablecoins are backed by fiat, by US dollars. Circle is a regulated entity. They put the US dollars in a bank account and in treasuries. Tether hasn't really disclosed where they put their money in, but we know that they must put it in a bank account, in treasuries and something, but they haven't really disclosed it like Circle. That is a different concept. That is what is backing the stablecoin. We want to make sure that there's proof of reserves, that there's proof of money backing the stablecoins. That's different from stablecoin payment liquidity, which is used to pre-fund transactions whenever you want to make a transaction to another place.
Let's talk about that in a second. One thing I just want to mention for the folks on the call, interesting thing about Circle, like there's all this question about Tether and what kind of assets are backing it and how transparent they've been. I think that has gotten improved dramatically over time, but when Circle launched, they were going to launch as being totally regulated. We're going to do this right. We're going to be completely transparent. We're going to have all of our, we're going to show you where all of these assets sit. Well, what they ended up doing was putting something like 2 or 4 billion in what they thought was a pretty stable bank account, right? Silvergate. And then when Silicon Valley Bank, Silicon Valley Bank. And when Silicon Valley Bank failed, that money got locked up. And in fact, they lost their peg for a while. Their peg fell to like 94 cents instead of $1. It did recover, but it only recovered after Treasury said, yeah, they were going to bail out all of the large balance holders of, Silicon Valley Bank. Had they not done that, Circle probably wouldn't exist today, or they'd be in an even worse position. So
Yeah.
interestingly enough, by playing by the rules and being above board and integrating with traditional finance, the weakest link in this case was traditional finance, and one of those companies failing that ended up impacting Circle. So just as an interesting aside with that one. So now back to you. Tell us about pre-funding liquidity.
Yeah, no, very good point. So pre-funding payments with stablecoins requires you to have stablecoin liquidity to use for this pre-funding. And I think there's a huge opportunity there, which is why I set up my company, Liquid Credit. Because as the world starts using stablecoins, as companies are starting to create backends where they build stablecoin infrastructure, there's going to be a lot of using stablecoins to make payments. What people are going to need is stablecoin liquidity to be able to pre-fund these transactions as some of these transactions are delayed. And that's a huge opportunity. The same way we saw a lot of payment financing opportunities in the fiat world is the same way we're going to see a lot of stablecoin payment financing opportunities in the blockchain world. And right now, there are very few liquidity providers that have real solutions to this problem. And the banks aren't doing it. The liquidity providers are usually opportunistic market makers. There's some companies that are being set up. So we're really trying to go in at this very interesting inflection point right now of stablecoin about to take off or taking off, and providing, I would say a couple of things to really differentiate ourselves when it comes to liquidity for stablecoins. I think one is we are creating an institutional asset class, right? This is an asset class. The same way banks make money out of payment financing is the same way institutional investors can make money out of stablecoin payment financing. Essentially, this is an asset class where it's a credit opportunity where investors can lend their stablecoins and they make a yield. And these yields can be in the double digits, because this is just like tokenized treasuries became really popular. This is another liquid instrument that can be really popular and grow to the billions in terms of the credit opportunity. And the second I would say is we are looking at giving fintechs that need this liquidity instead of a transactional relationship, we're giving them sort of like a credit line that they can use as many times as they want and generate revenue out of these stable coins. And we're essentially partners with them. Here's stablecoin floats, keep using it, make sure you maintain an interest cost, and make sure you're using it properly and you're generating revenue. And everything is done on the blockchain. There's visibility on all the transactions. So the credit opportunity is de-risked. And there's a huge, and it's a payment opportunity. So the stable coins are just going to make payments and generate revenue. And we're bringing a liquidity. We're building companies that we give this stablecoin credit line to, because at the end of the day, anyone who has a stablecoin credit line is essentially has the ability to use that liquidity to recycle stablecoins amongst each other. And as the world starts transacting with stablecoins, we're essentially creating this sort of liquidity network on chain. So that is what we're doing to really capture this opportunity.
So there would be investors that would provide that liquidity just the way that other investors provide liquidity with commercial paper or debt instruments or something like that.
Absolutely.
So and when you do that, there's a return. And that's why investors do that. These liquidity needs from a stablecoin transaction standpoint, is this most applicable to commercial clients or most applicable to consumer? I presume commercial, because they're big dollar amounts, right?
Yeah, I mean, it's the biggest opportunity for stablecoins is both B2B and B2C, right?
Yeah.
And to some extent C2C, right? Which is remittances. But yes, I mean, the B2B space is where I'm really excited about. And that's why there needs to be liquidity, because B2B, these are big ticket transactions where people are sending money to China, Hong Kong, to Mexico to do transactions, to do trade, right? A lot of them are trade finance, importing goods and paying suppliers and things like that. And so bringing those volumes on chain is a huge opportunity. There's $250 trillion B2B opportunity, and we haven't even scratched the surface of how much of that is going to be on the blockchain.
So Barbara, could I ask for an example? So let's say I'm an ag commercial tractor seller, and I want to buy a batch of tractors from India. So I want to use stable coins to do that transaction because my supplier wants to get paid instantly. They want to ensure funds availability before they let my tractors go on a ship to be sent here to the U.S. How does that work today, or how would that transaction work from a stable coin? And explain to me where the pre-funding comes in.
Yeah, so you're a tractor in Brazil and you're trying to buy tractor company in Brazil, you're trying to buy your goods from India. You're going to go to a fintech company because it's usually fintech companies that use stable coins, not banks. Banks are going to tell you it's going to take 3-4 days and it's going to cost, like you said, 6, maybe 10% if you're in Brazil. So you're going to go to a fintech company.
That's what we traditionally call trade finance, right?
Yeah. You're going to go to a fintech company and you're going to say, I need to send X amount of money to India to pay for this goods. The fintech company will take your local currency in Brazil and make an instant transaction to the supplier. And what the fintech company is doing in the back end that the consumer or the business that is the customer doesn't see is they're going to take that local currency, they're going to convert it. So let me give you 2 examples of what the fintech will do. One example is no pre-funding, and one example is with pre-funding. Without pre-funding, they'll take the local currency, they'll convert it to either USD fiat, and then if they convert it to USD fiat, it probably take another 2 or 3 days to move that USD to India, right? Because moving USD takes days in all over the world. Or they will take that local currency and convert it to USDC, and then send the USDC to a company in India that will off-ramp it into a local currency, maybe USD, but a local currency, and then give that to the supplier in India. That also takes several days because one, you have to get the liquidity to USDC liquidity on that local currency. And 2, you have to you have to send the USDC to the off-ramp provider in India. Those are 2 steps that you have to take. For a lot of fintechs, pre-funding streamlines the payment workflow. Pre-funding also provides liquidity. So when you're dealing with local currencies, it's easier to just not have to convert to USDC. So with pre-funding, all you do is take USDC from your credit line and send that directly to India. And that converts into the local currency in India. And if you have the flexibility to do that, you could do multiple transactions on a daily basis, right? Because now you don't have to be doing these conversions, finding the liquidity. You can just keep doing transactions and your volumes grow really quickly. That's why when people have stablecoin liquidity, their volumes grow.
So as being the tractor company that's buying the products from over in India, would I normally pre-fund it, or I don't have the liquidity needs? I would have an investor pre-fund it, and
So first of all, it's not the tractor company. They're working with the fintech, right? They go to a fintech. Tractor companies aren't thinking about pre-funding and are definitely not thinking about stablecoins. Yeah. What they're doing is they have a fintech company in Brazil that had told them, we will pay people in India for you instantly. So the fintech company is the one that if they're trying to do pre-funding, they will actually sometimes have their own internal stablecoin liquidity in their coffers, or they have to go to a liquidity provider and say, can you give me X amount of stablecoins? The liquidity provider will charge them a transaction fee for that and ask them to pay them back in like 2 days or something. That's what a lot of fintechs are doing, because you can't go to a bank and ask them for stablecoins. Right. You can't go to Coinbase and ask Coinbase for stablecoins, right?
Right.
This is a
But
credit
also,
line. Go ahead,
Barbara,
Catalina.
I was just gonna say, yeah, to Larry's point, because I think connecting the dots back, right, to that tractor owner, he's most likely going to go to his bank, let's say in Brazil, and try to figure it out. That's where there is the whole, foreign exchange transaction, the bank guaranteeing that payment, and then the receiving entity saying, yes, we got the payment, we can release the tractors to go to you, right? That
And
usually, I mean, in that world,
that's after a correspondent bank transaction, right? So
yes,
the local
right.
Mexican bank's going to convert it
Yeah. And
in
these are
charge
all
of
connected
a fee.
already.
They're going to send it to
Yes.
their corresponding banking relationship, which is going to then send it to the Indian bank, and they're going to do a foreign
Yes.
exchange transaction. And everyone in there is going to take a slice, and it's going to be expensive. And
Right.
it's going to take a long time.
That's right.
And that's
Exactly.
assuming that I had the credit that my local bank will even
Yeah.
assist me in that transaction, right?
And that relationship in the destination country, right, with that guy who's providing the tractor. So yeah, that's exactly what we face today, right? And it's provided by the larger financial institutions, on behalf of the system itself, right? So I think to connect it back to you think of eliminating a lot of that, right? If you have a platform like Liquid Credit, where in the ecosystem itself, you have the liquidity providers, you have the fintechs, clearing on behalf of the company as opposed to using their own stable coins, correct? And so with Liquid Credit, it's facilitating that exchange. Mm-hmm. And so if you're a financial institution, at some point you're going to have the option, right, to still keep some of that foreign exchange, because fiat and stable coins, they still have transaction there on either direction, correct? But the liquidity is different, because in today's payments world, that's the two things: immediate settlement and liquidity, and who takes the risk.
Exactly. The streamlining of payments is very important for all of this to be done seamlessly. Consumers, businesses are expecting transactions to happen instantly. We live in an instant world, and they don't care what happens in the back end. They just want this thing to be done. And so there's opportunity for tech-driven companies, and they could be banks. I think banks are going to go into this space. Right now, banks are using private blockchains. They're using tokenized deposits. As they, stablecoins essentially tokenize deposits in banks. But once I think some of these banks are looking at the public blockchains because they see more interoperability, more liquidity on the public blockchains. Private blockchains are still very focused on their customers. They're not able to expand outside their customer base. And so at some point they're going to go into this space and they're going to they're going to finance the liquidity around stablecoins for payments, just like they've been doing for fiat payments. They're going to come and do it on the stablecoin side. And that is where this is going to get really interesting. So, for us, we want to start building the ecosystem now, bringing all these fintechs that use these stablecoins, not all of them, but the ones that have really good volumes on chain within our network, where they can get credit lines and they can be financing pre-funding these transactions and instant transactions and generating a lot of volumes. And then as more traditional finance players come into the market, we will be benefiting off of that because we already have that network that they have not built, because they're just not focused on it.
So Barbara,
yes.
one complexity, and it'd be interesting if you thought this through, I'm sure you have, with dealing with fintechs and commercial institutions leveraging stable coins for settlement and payment. Stable coins are obviously backed one for one, and so that does tie up just capital in the system, right? And that's always been one of the things that Treasury and Federal Reserve have pushed back on, is that stable coin ties up a lot of liquidity. But like a tokenized deposit, at least in theory, is very different, right? Because deposits today are fractionally reserved back, they're lent back out on a fractional reserve basis. And so it's not a one-for-one backing. It may get complicated when we do ultimately see, it'll be interesting because there may be some transactions where the parties demand stable coins because they're backed one for one. There may be some that allow a tokenized deposit money to move because they trust the banks and the banks will do well by them. But it will add to some additional complexity if we do start to see the intermingling of tokenized deposits and stable coins. I'm not convinced we will see that. I'm not convinced that the financial institutions, the big ones certainly that are looking at it, will move anywhere beyond kind of commercial money movement. Like, I don't think they'll get into consumer, and they may not, maybe they'll use it for trade finance type of stuff, but I don't think you'll see it outside of that. But I think stable coins have a real opportunity that exists today and probably aren't going to go away. So like if I had to bet on one of them, I'd probably bet on stable coins, but I wouldn't count out tokenized deposits just because, banks and banking play such a big role in the economy and the creation of credit. It's interesting. So a number of people on this call are going to be credit unions and consumer banks. Is there an opportunity for this at some point? Do they help facilitate this in some way? Do they help provide that liquidity? Like what could be their, one of the things I think about is if you've eliminated the correspondent banking and you can do that, facilitate that international transaction, well then, the money that used to go that international, drawing a blank on
correspondent banking.
Thank you. That's what happens when you get old. Feeling like a president or something. Yeah, but the correspondent banking, you could basically take that kind of fee out of that transaction and capture it yourself. But I guess the question I've got is there an opportunity for a credit union or a community bank in this space with kind of what you're explaining?
Yeah, I think in multiple ways. I think the same way a consumer bank or credit union works with fintech companies to get into new markets, whether it's remittances, whether it's a business B2B payouts, B2C payments, technology-driven companies. I think it's the same way consumer banks or credit unions could work with our network of fintechs using stablecoins across these use cases. How do you work with these networks? Because these networks are global. They give you access to consumers and businesses that are underserved, they're probably not in your wheelhouse. How do you leverage that by being part of this network, by maybe using stablecoins through this network? Maybe they're your partners that you send stablecoins to when you're making payments, and then they can do that for their they can bring their customer base into your network. Also liquidity. I think banks are the best source of liquidity for stablecoin payment liquidity, and we see that opportunity, and we want to prepare for that, for banks to be in this game, and we want to work with banks in the future and say, hey, you should be pre-funding these stable coins. You should be providing the liquidity for these fintechs and technology companies to use stable coins to pre-fund. And so I think that is going to be an interesting partnership opportunity over time, because what people are gearing up for is that there are going to be many stablecoin issuers here. We just talked about Tether and Circle. We've seen conversations happening across the board around Revolut, for example, issuing a stablecoin. We've seen PayPal issue a stablecoin. We're going to see more. Yeah,
now Stripe, right? You can come on a Stripe, and the latest acquisition of Bridge.
Stripe just bought a stablecoin payment company, and that was a really big transaction for a small company.
Yeah, 1.1 billion.
Right. And so I think banks, for them to be part of this ecosystem of technology, working in our, with our liquidity network or being part of this sort of stablecoin payment liquidity conversation, I think is going to be absolutely crucial going forward as stablecoins become the new rail for moving money.
Yeah, I see if they don't, I guess one of the risks I see is that the fintechs yet again take another aspect of banking type business, which would be helping facilitate commercial banking, right? I mean, they may not, fintechs may not have a lending function, but if you're talking about movement and payment and dealing with vendors and those sorts of things, if that's the preference of the client is to do that as an instant payment with a stable coin, that's going to be a problem. Now, I guess if I'm a let's say I'm a bank that has a commercial business, my natural reaction to go, oh, well, that's what I use RTP for. That's what I use FedNow for. And that's true for domestic, but right now, neither one of those are international. And so it doesn't solve for, this growing group of businesses that now have cross-border business. And that is probably a really big number and getting bigger every day because of supply chains and those sorts of things. It's not, if you're in the US, you're not just dealing with US suppliers, you're dealing with China, you're dealing with Malaysia, you're dealing with Vietnam, Mexico, whatever, Canada even, and that does create some complexities.
Absolutely. I think B2B in the US is probably the most still very, very outdated when it comes to financial infrastructure across payments, lending, you name it. We're still dealing with a lot of manual checks within the B2B space. I think B2B, where you're moving large ticket items across all these supply chains, like you mentioned, stablecoins are going to be really important. And we're talking about, there's so much innovation right now. You can issue stablecoins from an accounting software. You can actually use stablecoins within your accounting software. There's some innovation around that. That's going to really revolutionize B2B. Just think about payments, invoices being paid and settled with stablecoins directly from your accounting system. That's just a whole conversation in itself. And so there's a huge opportunity with B2B, and a lot of the high ticket, large ticket items are really in the cross-border space when you're dealing with global trade. That's a bank. Those are where big banks have made lots of money. It's from cross-border B2B, and that is now up for grabs if you own stablecoins and you have stablecoin infrastructure. And so, like you said, I think banks and all these big companies are going to want to be part of that.
Yeah, I wasn't surprised, but I kind of was surprised. I've been doing some research looking at trends in banking for 2025 and what are the big items. And I was surprised that cross-border was there as a big focus for 2025. And again, surprised but not surprised. But I think it does speak to the fact that these type of solutions are to serve that need, and if that provides an efficiency gain or a revenue source for fintechs or financial institutions, boy, we ought to be looking at that and considering it. We've got 5 minutes left. I don't know that I got through any of my questions, but I think we probably covered most of those. I did have a question. Do you have any competitors? I think corresponding banking in the existing process might be one of those, but are there any other competitors out there?
Yeah, I think anyone that provides that's currently providing liquidity is a competitor. But the market is so big that I look at all of these competitors as just fueling the stablecoin ecosystem. We haven't there's still gaps in the market around this liquidity in terms of where the liquidity is going. There's still a huge opportunity with emerging market corridors. There are very few liquidity providers that serve those corridors in a cost-efficient way. And the way liquidity is delivered is still very transactional. We need more more of a partnership approach where people can use liquidity as many times as they want to really make it make sense for them, make it make more money for them. So I think there are still gaps in with this conversation that there's still much more innovation, and we want to be in that space. And as we talked about, as more stablecoins are being issued, not just dollar backed, but like non-USD stablecoins. We think about everywhere in the world: Canada, Japan, Singapore, Brazil. I think Brazil's stablecoin is like the second largest stablecoin in terms of transaction volume. And so there's going to be liquidity needed for all of these different new stablecoins, some of these big stablecoins in non-USD areas. And so there's a huge opportunity there. And no one is really building something that holistically solves all of this. So there's a lot of opportunities for new players, frankly. But for us, we want to get started and get things going and be prepared for this new stablecoin adoption that's going to blow everyone's minds.
So two questions for you, and I'll ask them both at the same time. One is, what are your next steps with liquid credit? And then two, I presume up until this year, like you were probably facing some regulatory hurdles, whether it be from the SEC, from the CFTC, from the, I don't know, banking regulators or whatever it may be. It seems like with the current new administration coming in, some of that might be loosened a bit, inappropriately so. I think there was too much regulation, go back to Choke Point 2.0 and all that good stuff around digital assets and blockchain. So I think we'll see a revolution of innovation in this space, and you're certainly being innovative. So what are your next steps, and do you have any headwinds or tailwinds?
Our next step is we're already pushing ahead. We're bringing in liquidity on our platform. We're raising equity financing and continue to raise debt capital financing. So we're growing and we want to build this out. I think from a headwind perspective, it's really getting institutions to see this as the next asset class, right? I think institutions still look at the blockchain and they sort of say, is it compliant? Is it this? Is it that? Is it secure? We're trying to solve that problem we're working with a compliant wallet provider. We have one of the best custodial wallet providers that's very secure. We're de-risking the opportunity with the blockchain. We want institutions to use the blockchain. Like I said, I started this conversation saying I became an investor in the blockchain because it's solving things that traditional finance has not solved. And I think the blockchain can be used very effectively for credit. At the end of the day, we're giving credit and we can have complete visibility on these credit transactions. And that is an advantage of being on the blockchain. So we want the institutions to understand that. But that blockage of the blockchain and with institutions is a continuous headwind for the entire industry. Tailwind is what we just talked about, right? There's a huge adoption right now of stable coins, and we're really just at the center of it because what we're doing is going to fuel stablecoin because we're creating a liquidity flywheel effect. If we give you a credit line, you're recycling stable coins. The more you recycle, the more you recycle. It's literally self-reinforcing. And so we're actually driving the adoption of stable coins by doing this. And so I think we're really at that inflection point of growth by being involved. All the people in this space that are doing this is actually they're part of this wave. So yeah, we're excited, and I think the regulatory environment is also going to potentially be a tailwind because the biggest thing that the market needs in the US is a stablecoin bill, and we're hoping that the wonderful powers that be will put that in place now that they see the importance of stablecoins.
Yeah, I'm 80% sure we will see a stablecoin bill that will make it through both houses of Congress. So both pieces of Congress, the House and the Senate.
I think so.
Okay, well, hey, let's see if there are any questions, and then we'll wrap it up. But this has been really helpful. Let's pause and see if there are any questions from the group. When there aren't, that's usually a sign you did a really good job.
Yeah, I know. We had so many questions throughout, so I think absolutely.
Yeah. Well, we will. Our next Tech Talk will be called Perspectives Live, and that's going to be January 16th. So please sign up and opt in because that's going to be our way of communicating when these things are outside of just posting it on LinkedIn. Barbara, I want to thank you. This has been a fascinating conversation. My second conversation with you. I loved both of them. Looking forward to having more of these and hearing more about your success in the future. If there's anything we can do to help you connect to folks, don't hesitate to ask.
I really appreciate this. This was a lot of fun. I can talk about this all day, clearly. So please, anybody reach out to me. I'm on LinkedIn if you want to have further conversations. But really appreciate Catalina and Larry putting this together.
Yeah, definitely follow Barbara on LinkedIn as well as Catalina. They have a lot of really interesting stuff. So thank you very much. And with that, everyone have a joyous holiday seasons. Happy New Year, and we'll see you January 16th.
Happy holidays.
Bye.
Thank you, Larry. Thank you, everybody.
Thank you.
Thank you, Barbara.